Happy New Year, everybody, and welcome to this week's edition of Top Down Review. This is Jeffrey Scott. My email address is hgsidoc@gmail.com. It is January 2nd, 2022. I entitled this week, Markets End the Year with a Whimper. I thought about using Rudolph Catches a Cold or other things to describe the tease on Monday of a Santa rally and then the market sort of tailing off. Keep in mind that we have a few more days of potential rally for Santa Claus. I welcome comments, even negative ones. You can email me at hgsidoc@gmail.com, or you can put something in under the remarks. Just a quick reminder, if you're watching this on YouTube, in your lower right-hand corner, there is a place, a gear. You want to make sure that you have maximized the resolution. I record this in 4K. And oh, by the way, it might be noon on Sunday before the 4K version is posted by YouTube. The longer I talk, the longer it takes. Also in the remarks section will be a link if you want to download a 4K video. This is for educational purposes only. In the spirit of that, anything I say should be considered just education and not investment advice. I'm a doctor, not a broker. I am independent today. That could change in the future. I paid for the tools that I use, and trading involves risk, and you alone are solely responsible for any investment decisions you make. I call my trading, and when I used to teach people how to trade, to be your own guru or be your own trading guru. In fact, I actually have a website which I'll be launching this year called BeYourOwnTradingGuru.com, and that'll be my new email address as I launch my new offering that I'm considering. And my whole philosophy has been, most of us are not math wizards. Most of us are not engineers. Most of us are not creating science. Most of us are reading about things, learning from whether it's webinars or live education when we go back to that, and we're coming up with our own way of trading. That's what I have done. And some of the influences on my trading is here. I like growth stocks. I got indoctrinated by O'Neill. I think some of the things that I learned from Morales and Katcher improve upon that. Ian Woodward, just a great guy. John Person, Rob Hoffman, and others, Sager, have been some of the influences on my trading. Now, my style doesn't have to be your style, and you shouldn't strive to copy mine because, hey, I've got my own unique way of doing things. But you should learn from smart people and put together what works for you. I own a lot of equipment. I have multiple monitors in front of me. And if you came by when I was off work and actually trading during the day, which frankly, my style doesn't require that, you would see at some point TradeStation, Thinkorswim, and wealth charts on. You'd see John Person's indicators, Dr. K's, Sager's Q tools. And then you would see, besides wealth charts, High Growth Stock, Investor, and Edge Rater. These are my go-to tools. I'm really excited. I'll be speaking at the Wealth 365 event. I've been talking about it for a while. And here is the link. If you haven't registered yet, or if you want to register and call out that you learned about it from me, here is the URL for that. Now there's 14 days. I will put this in the remarks section so you can click it and register. There'll be a lot of different people talking. It's educational. Most people, not necessarily myself, because I don't really sell anything, but most people will have different offerings that you might consider. Speaking of offerings you might consider, I remain a very big fan of highgrowthstock.com. Free 30-day trial under investing strategies. You'll see hundreds of movies. And then remember, I said I like CanSlim growth stocks. Talked about O'Neill for a second earlier. These stocks go up like rockets. Making 300% in 2020 was not unheard of with these kinds of stocks. They're not working now for the most part, and they fall like rocks. So you really have to know where you are when you buy, and you don't want to be buying falling knives. And there's a lot of falling knives in this market. I mean, the Affirms, the Unity Softwares, the Upstarts, some of them are moving, the Babas, etc. And they probably at some point will stop falling, and you'll look at percentage returns from that point, and they'll be huge. But the last thing you want to do is buy something that's fallen from 200 to 120, watch it drop to 80, and then have a 50% move from there and get back to where you bought it for. I mean, it's better than losing money, but you'd rather capture some of that 50% move. So I always think of every stock, industry group, and frankly, the major indexes with this pattern. And this pattern repeats itself over and over again. And this pattern is fractal, meaning you can see it in most time frames. Where are we today? Well, I think it's a very bifurcated story. If I look at large cap stocks, the Dow and the S&P setting new highs again this week, we're probably coming up this grade still, although I think the entire market is up here at the top of this uncertainty area, while the Nasdaq and the Russell, especially the Russell, have given signs of falling off the cliff, especially some of the smaller cap Nasdaq stocks. Now, I've been talking about this like a broken record for a year now, that you can chop off the top of this and create sort of a Darvish box and a sideways feel. If you don't believe that, look at some of the indexes like the Russell. And for the most part, every time it looks like we're going to new highs, we seem to sell off. And we set a nominal high and then we come down. When it looks like we're selling off, we set a nominal new, recent low and we go back higher. This has been a very choppy, very challenging market. So the right position probably would be to raise cash and have smaller positions. But there's been a lot of whipsawing. And as I mentioned, some of the large cap stocks, think Apple, although it sold off some this week, NVIDIA, Tesla, again, perhaps at risk of selling off here, versus some of the small cap technology and biotech. You got two different stories. So I have cash. I still have too many positions, although I have less. I have sold premium against most of my positions because I don't expect a big leg up to occur here. Doesn't mean we're going down. And I'm a little bit nervous about this market. Now, the market is made up of sectors. The sectors are made up of industry groups, and the industry groups are made up of stocks. Starting right here, you have materials and energy. They look pretty good. Financials at best are mixed. Industrials look strong if you look at green being an up day on Friday. Staples, a defensive play, very strong on Friday. What does that tell you? Well, technology weakened. Discretionary, not as strong as staples, but still strong. Utilities, another defensive play, very strong. Healthcare weak. Communications weak, although it was stronger earlier in the week. And real estate were mixed. Well, I get a sense real time of what the market's doing by watching that. Now let's look at the major markets. Now those who've been here before know that I spend probably more time looking at the markets because frankly, whether you make money this week if you're long or short is probably more related to what the markets do than your genius of stock picking. Because right now the markets, I think, are the story. So when I see this white little balloon here, this is a 1-year chart of the S&P futures. What does that little balloon tell me? It means we had a new intraday high set on Thursday. And it looks like we probably had a closing high set on Monday. Now notice what happened after Monday. A couple of dojis and the market started selling off. Now, it's hard to be bearish when you see the low of the 1 year being on the first day on the chart and the high being 1 day ago. So the market really ended up near the highs of the year, which is bullish. Short term, I see concern. What do I see concern about? I see the OBV has fallen off. I noticed that we had a couple of stalling days, then we started coming down. But then I looked down here, and there really was no volume. So I think this is a holiday week. As I said last week, expect to see some volatility, probably less volatility than expected, but very low volume days. So If this was regular volume, I would be thinking a pullback to the 17 or 50. Modest pullbacks would be in the offering, and they probably are, but we do have a few days left of the Santa Claus. This is seasonally, especially the beginning of January, a strong time. So I think you could, probably expect a mixed offering. If there's three roads to the scenario, the first road is we go to new highs, which is not very far. The bad news would be a breakdown to the 200, which is unlikely yet, but may happen later in the year. And then probably the middle road scenarios to continue to bounce around in here between this area here, the nominal new high, and the major moving averages. So that is the S&P futures. I look at the Nasdaq futures. They're already moving down towards the S&P, towards their major moving averages. The high was set earlier back in November. Doesn't look like it's had as big of a move as perhaps the rest of the market had this year, but it still had a very strong move. Look at the Dow futures, excuse me, I don't know why the default does that. Now you start to see something that's really moved kind of sideways. All right, we're in this area. We were more sideways earlier. We broke out of that range. The recent high set on Thursday, closing high probably set on Wednesday. And again, volume came down hard this week, not a big shocker. Just like the S&P. Could it go on to new highs again? Absolutely. Could it come and retest those moving averages is something I'm going to be looking for. The Russell futures, let's talk about sideways markets. If you define that as the top, you define this sort of as the bottom of the range. And we've been going back and forth between the top and the bottom of the range. Where are we at today? We're right in the middle. A lot of resistance here with the 200-day and the 50-day. And I'd love to see it clear there. Look, no volume again. Now, the thing that really bothered me about the Russell is it really felt like we were breaking out up here, and what we had was a false breakout. Eventually it'll break out, but the Russell has pretty much gone sideways for 9 months. The VIX, now if I went back a couple of years, you'll see that it was down in the 15, 16 range for a long time. Then it was in this range of 16, 17, 18, and now it's resting at up here, which is much higher, approaching 20. Now, does the creeping higher of the baseline of the VIX scare me? I don't know if it scares me, but maybe it's telling me something. But if you want to be bullish, it's come down. It's now dropped below the 200-day moving average, and it's not really giving me a signal. If I look at the dollar has weakened some, and I'd love to see the dollar come down because if you're a small cap growth guy, a strong dollar is not necessarily your best friend. If I look at weekly, just take a look from a high level, you can see how we've come on all the indexes. You can certainly see the flatness in the Dow to some extent over the last 5 or 6 months. You can see most of the year has been flat on the Russell. And the dollar is going to have a 200 weekly moving average down here, which would probably be some support. But the dollar, although on the weekly it's had a big run, it's still way off its prior highs. Let's flip this back to the daily so I don't fool myself later. The expected moves I thought were really, the charts were brilliant this week. And, because they really defined what we saw. I really like having these real time on my charts. Why? Because let's review what the expected move is. The expected move is the cost of going long a straddle at the money on an instrument. That means you're buying a call and you're buying a put. Your premium that you pay is going to be a combination of the call or the put, and the stock will need to move in one direction greater than the premium you pay to make money. Now, the other side of the trade is the smartest money in the market, who are the option sellers, and they're going to price it. So odds are, and when I go back and look at the data, it's over 80%, although maybe mathematically it's not supposed to be that high. Over 80% of the time, the stock or the instrument is going to finish within the expected move. Now, you are going to lose on one. If you hold it to the end of the week, you're guaranteed to lose on one of the positions, because you can't make money going up and money going down if you have if you sell at expiration. I guess if you're really good, like on the prior week, you could have sold your put down here and sold your call up here, and you would have actually made money on the trade, where if you'd held it to the end, you would have made just a few pennies. But you have to see an outsized move. So here was the expected move for this week, and it was a narrower expected move than the prior week. And on Monday, you took out the expected move. Now, one of two things was going to happen. We were just going to go straight up and have a crazy move, or the market makers are going to be right, and we're just going to come back in and finish within the expected move. So what happened? Doji, reversal, and a low close doji finishing within the expected move. Who made money on this trade? The market makers, although you didn't lose much money. You lost down here, but you didn't lose. Your call kind of broke even. So imagine if you're the market maker. You made the full premium on the put, and you broke even on the call, or made a few pennies on the call. Not a bad trade. Now, if you were watching this, you would have seen here on Tuesday and Wednesday, and you probably would have positioned yourself for the market to come back in. I did. If you look at the Nasdaq, same thing. Monday ran up, Tuesday hit the level, came right back down, closed where it opened. Is that information you could trade with? I think so. If you look at on Wednesday, I mean the Dow, same thing, except it took the Thursday to hit it and come back in. Imagine if you're just selling calls up here and selling puts down here. You become the market maker, and 83% of the time you're going to make money. Of course, a naked call or naked put can be expensive if you're wrong. So you might create a trade where you're selling and then buying something above, selling and buying something below to protect yourself. If you look at the Russell, massively unchanged, as Don Kaufman would sometimes say on a video. All right, if I look at the VIX, interestingly, despite the market really not being that exciting, the VIX sold off some and really came down. And what did it do? It reversed off the bottom and went sideways. Really no signals there. And if you look at the dollar, traded to the lower part. So the market maker made all the premium on the call it sold, because this is the premium plus the strike price. You have to get above this to make money on the call. Well, obviously that went to zero. And on the put side of the straddle, the market maker still made money, because you didn't break even as the buyer until you got down here. So I think, especially when it behaves like this, that these can be very useful in your trading. Just to prove a point and not to spend much time with TradeStation today, let me find it on my computer. If I was to look at, say, the Nasdaq, if I was to look at any of them, right, the Nasdaq here is a little worrisome. I've got a daily sell, a weekly sell, still in a monthly buy. So that's 2 out of 3 strikes against me. I got a blue bar here, which is not bullish. It's not necessarily bearish. It's a neutral bar. And remember, these are the Alexander Elder Impulse Indicator. Green, I should be buying or holding. I shouldn't be shorting. Red, I should be shorting or holding. I shouldn't be buying. Blue, I can do whatever I want. But what I really wanted to call out is not only are these markets under pressure, and you can see the weekly bongo remains in a sell signal, which is not bullish by any means, is our high jump indicator will be useless, meaning not an issue here. You can see it's at 47%. So obviously we've come off extended levels and we're in an area where I hope you realize this is not the world's strongest market. Now, what's underneath? The rates actually may went up a teeny bit, but mostly flat into year end. And you could see if the year started down here on the 10-year on the left, we had a pretty healthy gain, no surprise. This increase that was rapid here, I think, spooked the market. I'm not sure that this is at a level, if it stayed flat, that the market couldn't handle. If you look at the longer term 30-year, it's kind of interesting. It's almost at the exact same level that it entered the year. Again, a big run up, but a steep run up, which is probably more bothersome than a big run up, and it came back down. If I look at AD lines, these have continued to be a challenge, where the large caps, as indicated by the Russell 1000 AD line in white, back to near, at or near all-time highs, and it's hard to see the IWB, the Russell 2000 ETF, also almost neck and neck near new highs. So large caps, ADs are doing fine. Not small caps. Small caps, the AD lines could not take out the prior high, even though, as you can see in green on the IWM, it did take out the prior high, and they're both considerably off their high. So you've got a divergence in small caps from the large caps. And if I look at the NYSE, you can see for the most part it's turned up. This is the IWM, which is lagging small caps. Rates were up a teeny bit and bonds were down a teeny bit. What about breadth? When I look at stocks above the 200, stocks above the 40-day, they both improved this week. So I said over a longer time frame, breadth improved. Improved a little bit. Yet it's interesting, on the 21-21 12-week new high, new low ratio, breadth actually turned down some. I should have switched the colors. This is where we were last week, and here's where we are this week. The McClellan, I'm trying to make a story here. We did nominally get higher highs on the daily, and we got higher highs than we've had. Does this mean we're breaking out of our negative divergence? Wow, wouldn't that be awesome? But again, if you look here at the summation index, we're still way down, even though we've had highs. And on the weekly, again, the oscillator, not at an extreme, but you could almost make the argument that it's starting to take out these highs that we've seen earlier in the year, which would be bullish. Looking at the market, despite the fact that I don't feel massively bullish right now, and I did not feel like this was a super strong week, 84% of the stocks in the S&P 1500 are trading above their midline of their Bollinger Bands, while very few stocks are above their bands, and you could see very few stocks are in the lower part. So that would be a very bullish appearing. So this is the date we looked at. This is just from a list I created in July. I update them twice a year, and I'm redoing my list today. Hindenburgs. Well, we know Hindenburg omens are bad, and we could see in November we had multiple Hindis firing on the Nasdaq, similar in the NYSE, and I think we clearly saw some weakening of the markets. We saw again on December 15th and 16th, the NYSE through Hindenburgs, but since then the number of new lows has dropped below the requirements. What's interesting in the Nasdaq really is a mixed bag. Don't have a Hindenburg omen firing recently, but we still have a lot of new lows to go with a fair amount of new highs. And when you think about market tops and what the Hindenburg is, it represents a period of time when the smart money is saying it's time to get out, and the dumb money, us, are buying. And you get a lot of new highs and new lows and a lot of volatility. And this has been a tough market, so I don't know if I want to ignore these signals. I think you could say that the confirmed signals actually did lead to a minor pullback. I'm not convinced it's over. Now, if I look short term, market tone is essentially green across the board here, the Woody indicator. Obviously, that's bullish. Boring week. It didn't do much. I guess high relative strength and EPS rank were good. Now the S&P, I'm a little bit confused here. I looked at this from Friday to Friday, and it's supposed to be positive, and it's negative a bit. And I don't think we had any days off, so something is screwy here. So I'm going to ignore most of those calcs. Now Sager has got these great market tools, and a couple things I just want to point out is this blue line is small cap versus large cap. When the line is going down, it means that large caps are outperforming. You had a little air period, a little bump in the market of small cap turning around. And remember, I said in the beginning, bifurcated market, especially within growth, the market's been kept up by some large cap. Strength in small caps would probably be a really good thing. I think what we saw this week was some bounces off the bottom, people looking for bargains. We also clearly saw in this period of time some tax loss harvesting. If we look at growth versus value, again, rising means growth is in charge, falling, value is in charge, and we know we've had a lot of value rotations. We went back into a growth in charge. So I think what we saw this week was small cap growth actually catching a bid. The skull and crossbones are actually Hindenburg's, and when he does sort of a combined total view of the market, you could see we had a series of Hindenburgs here in November. We actually had one here earlier December, as I mentioned before. You can look at distribution in the markets in these red dots. Green dots is accumulation. And right now it's kind of nothing big happening, which I guess goes with a quiet holiday market. Sector strengths improved. I mean, clearly in the S&P 500, which is more of the, the larger cap stock names, the market looks pretty strong. Now, if I look at the S&P 1500 with Q tools, you could see we ended the week, here's Friday, here's Thursday and Friday combined, sort of in 50-50, where the market was mixed. But if we step back and we look at a month or 2 weeks, the markets were definitely improved over where they were. So the markets had strengthened, and we saw that. But the last couple of days, the markets sort of petered out, kind of like those expected move charts. This is a real-time version of the buckets that comes from QEdge. Again, showing most of the stocks above the midline. Came down a little bit, not much change from the prior day. Sector performance on the week, we had 8 up, 11 down, and 6 and 5 on Friday. So rather than ranking them by the strongest sectors, I was curious to rank them by the ones that over 5 days had the highest movement up. And I was probably disheartened to see what we saw in the trade station picture, which was the defensive stocks were leading, utilities and staples, and then materials were a third. Now, this only difference between this and ranking from the top down is industrials. But industrials are weakening, so I decided it was appropriate to leave them out. I then took the top 3 groups, and these are our sectors, and these are the industry groups. And you can see diversified chemicals. And this is looking at 5-day movement. Really has had a fairly, this was looking at top performers, has really come to the top after being weak over the prior several months. So diversified chemicals, agricultural products, so on and so forth. I'm a cancer doctor, so no matter how good a tobacco stock looks, I'm probably not going to buy it. These become the stocks in the leading groups. These are the stocks that were the crown candidates, undervalued with great earnings per share growth. And, the one that really stood out that I put on my buy watch list is Cleveland Cliffs, which I already owned. It came down to test trendline support. It had hit it here, it hit it in here, it hit it here 2 days in a row, and then had a nice move off of that on this week. This is a weekly chart on the left. And on the right, you could see over the last 10 days, it's moved up. may come into some resistance up here around 24, but in a downtrend, I somewhat get less bothered by this, and I set my target to go against prior highs. I thought Cleveland Cliffs looked interesting. Canaries in the coal mine had a false breakout on Monday with the rest of the market pull back to the 50. Now, we are in the season of Netflix, so I thought I'd make a couple comments with 30 minutes in. Historically, this has been my favorite trade of the year. Now, let technicals guide you and not the calendar. All right, there's no guarantee on anything, as you'll see. I like to play this with options. When George Lee was alive, we'd talk at a lot of meetings. We usually have a meeting in March, and we'd be reviewing our trade. George would take out of the money options. I'd do at the money options. George would get a massive percent improvement, and I'd be happy because I made a lot of money. And the question always was, which is better? And I felt that if you had the capital, at the money was less risky. And if you do out of the money calls, you have to buy enough so that your 300% return on $10 is still only $30. So you got to put enough money in. I'm going to show you how EdgeRater actually helps us understand that. I have multiple seasonality programs. Rob Hoffman has announced multiple times that seasonality is coming to wealth charts. That would be great. Dr. K's got some wonderful seasonality tools, which I believe will also be coming to wealth charts. Upper right-hand corner, this is seasonalitytrader.com, I think. Yep. And this is looking at Netflix. So what is it showing you? You can see the candlesticks over the last several months. And, you know, after a run up here in October, November, Netflix has drifted down in December. These are real. So if you put a linear regression channel on Netflix, it's heading the wrong way. This here is earnings, which is actually the start date. Earnings are over here, and you can see what earnings has a tendency to do to Netflix. And when you run programs, they'll give you start and stop dates. So Seasonality Trader says you buy Netflix on December 31st, you sell it on February 10th. It's been up 9 out of 10 years for a 35% return. Well, that's impressive. But I like to see a technical pattern that I'm ready to buy. Although, if I look at the day before, the day of earnings, it comes out the Tuesday after the Monday holiday in January, and it's after hours, so you can still buy it on Tuesday during the day. I got to watch my technicals. Best choice, this is the revised best choice, since it's been bought by Jerry, and is now web-based. This is the mathematical interpretation of, if you take all the years of activity of best choice, this would be the average seasonality curve. The accumulation of these dots are when the earnings dates are, and there's over here. And then I actually asked it, looking at the entire picture, what would have been the best time to buy the stock with a hold period of 14 or 15 days, I think is what I asked. So it said actually buy the stock on right around the earnings dates, which is January 21st, selling it on February 4th, 15 wins out of 17 years. So that's a win percentage of 88%, average profit of 15.66. And you could see here in the bold numbers the moves it took from year after year after year, and you could see the percentage returns. So interestingly, two different very good programs giving a little bit different trade, although they're still concentrating on this move up. So let's say you want to take the trade. I play with options. Should you go with at the money, out of the money, or deep in the money? Never seen this before. This is a new template by EdgeRater where I could put in my start date and my stop date. So this would have been this year, December 30, 2020 to 2/10/2021. Now, it's interesting where in Best Choice, using their tight dates, it was a negative move. But using the seasonalitytrader.com dates, it was a good move, up 7%. And that's because Netflix came early this year, and you needed to be in Netflix long before the earnings. So cash value up 7%. Let's talk about this chart here. This chart here looks at days to expiration. So this would be a March, April, and so on and so forth option. And then the delta. Remember, at the money would be around 0.5. In fact, if I pull up Netflix right here, it's trading at $602. And I look here at this line here, at the money, the delta is 0.52. So 0.5 is at the money. And if you look at, for example, a 0.8 option delta, you're deep in the money. You're $50 in the money, more than $50, $60 in the money. And if you look at like a 0.2 option, you are $70 out of the money. So it takes a really big move. So buying at the money to me is the lowest risk because you have less of a move to make money, although you still have to move at the money from 605 to 633 to break even. A deep in the money is probably you don't pay a lot of time value, but if the market crashes, you risk a much bigger premium. Out of the money, you're risking a lot less, but what does it take a big move? Well, what's the winning answer? Well, if it's a negative, it was buying a put. So since the market went up during this period of time, buying a put was minus return across the board. So you want it to be in a call. And at the money call, with a 2-month duration, return 13% on the trade. Now, that's twice the return on the stock. Your only risk at buying an at-the-money call is your premium. If the stock dropped 50%, all you can lose is your premium. And so last year, I would have been right. Buying an at-the-money call had a much better return than a deep out-of-the-money call. Now, a deep in-the-money call actually did pretty good, but remember, there's a risk thing here where your premium is big, and so you run the risk of losing capital if the market goes way against you. Now, what happened if I held this trade longer? It didn't really get better. So let me go back and find the right one. Oops, why does it look different here? Hold on a second. 7% return, yep, 0.5, 13, it doubles a little bit if I held on to it, yet the out of the money calls, it took almost a year for them to catch up. So last year, 7% return on stocks, return during this period of time of a 2-month duration at the money was 13%. That's nice, it's nothing great. 2020. Netflix was up 15%. And now you start to see the power of the cheap out of the money calls where delta 0.2 and 3 kind of were very similar to the 0.5. But remember, a percent return is one thing. You got to buy enough stock or enough options on these out of the money cheap options to get any kind of a win. I mean, doubling your money on a $2 premium is only $2. So again, at the money, out of the money, at the money outperformed the out of the monies. 2019, Netflix is up 30%, at the money, out of the money. So out of the monies had these massive returns. So this is one where George would have looked good. But again, even at the money options, 262% return in 46 days to expiration versus 30%. 2018, same 30%. At the money, 471%. This is a year where look at the massive returns on the deep in the money options. So George Lee looked pretty good here in 2018. 2017, Netflix up 17%, at the money up 150% was the way to go. So you can make money both ways. I think you've got to buy a lot more of the out of money options if you want to look at making the same dollar amount, but you'll get a much bigger percentage return typically in the out of the monies. But I think a higher risk of losing money, because here in 2017, for example, the at the monies were great, but the ones that were way out of the money did not make money, at least the ones that were 49-day duration. So I think you can learn a lot from this tool and help you understand which is the right option for you. And again, not to reiterate, but just to, a out of the money option, a delta 0.2 only costs you $7.85. And at the money option costs you $29. Well, Jeff, I'm going to spend $7 and hope for a home run. But think about it, the stock would have to go from 605 to 687. So $82 for you to break even. If I bought the at the money call and moved $82, all I got to do is I'll have $50 profit in it. So that's why I like at the money. Trade at your own risk. I'm not vouching for the trade. This could be the year it goes against you. Know your news and earnings. I was expecting, maybe we'd have an easy week, and I screwed up on this. This is not Bloomberg. This is Market Watch. But you could see we've got PMIs in construction. We got ISM, a bunch of job things. We got JOLTS. We got employment, ADP on Wednesday. PMI, we got the FOMC minutes. Are they more bearish than they presented? On Thursday, we got initial claims, trade deficit, factory orders, and then we got, as John Person loves to call, the monthly unemployment report, non-farm payrolls, unemployment rates, hourly earnings, and then some credit. Major week of news. Not a major week of earnings. I own some Greenbrier that I'll have to decide. And as I say in the lower right-hand corner, it's a judgment call to hold stocks over earnings dates. It is bad judgment to not know when your stock's earnings date is scheduled. Even though you may not have something here, let's say you own some steel stocks. It might be interesting to see Schnitzer's and hear what they're saying about the steel market and steel pricing. So I'll often pay attention to earnings, even though they're not my stocks, because I might learn from them. A lot of words here. Week was okay for big caps. It was down a little bit for small caps. All right. On the Nasdaq, let's see. As you can see, if you look at Friday, everything was down. The Nasdaq led it to the down. On the week, you could see here S&P and Dow are up some. Nasdaq and Russell dropped a tad. Nasdaq dropped a tad, Russell increased a tad. Really a flat week as we saw on the expected move charts. COVID news dominated. We limped into the end of the year. I decided, right or wrong, and it kills my margin account to do this, that I dumped a lot of my big gains and took money out of the market. I've got a house I got to close on in April in Santa Fe, and I made a lot of money in 2020 and a decent amount in 2021 that's going to pay for the house. So I decided to take my gains this year because, obviously the left would like to raise capital gains. We have so much debt. I think taxes are going to end up going up before we know it. So why not take your capital gains now? I doubt they're going to go lower. And then I harvested whatever losses I had, which were not enough to offset, but I harvested some losses. I've been in Amazon since $450. Amazon went flat this year, and when I did my post-market review, all that protection I put on it probably cost me a couple $100,000. So it made no sense to keep something sideways, especially if I can sell it at a tax rate which is favorable. This will be an interesting year. You can argue for the bulls and the bears. If you're a bear, the economy is slowing, COVID's not going away, the Fed is tightening, and they're tapering their buying of mortgage securities. That's ugly. If you're a bull, inflation's temporary, the economy holds up, and the Fed's going to not raise as much as they told us. I think you can argue both sides. Whatever, this will be a heavy news week, add some COVID, and we might see some movement in the markets. Again, this was a strong market, but if you go back to May and look at the numbers in May and June, they probably were better or close, at least on the Dow and the Russell and the Nasdaq. It was a good year. I made money. I beat those numbers. But if I look at the percentage I was up in May and June versus where I finished the year, I hate it, but I gave back some profits. It is what it is. It was a choppy market. What saved me, to be honest, is I took profits throughout the year and took money out of the account to build up for the house that I will close on. Again, Summit coming up. Please use this URL. I'll stick it in the website. I get nothing. I'm not paid to do this. I'm going to give away something to Wealth Charts users. I've called it my DOTS indicator, which is being programmed, which I'm going to rebrand as my market EKG. And because to me, it really gives me a sense of what the market is doing. That will be added to Wealth Charts if they can get it programmed. Working on some other things. I've said it before. In my last year, my wife says I'm a senior, like senior in college. This is my last year of work, and then when I retire, I'm going to devote myself to trading more and doing some things around education. So this is the URL, and let's go take a look at the markets. All right, we're at 46 minutes. These are getting so long, I got to stop. So I always start by going to 01 and the market analysis, doing a top-down review, gold, mid-cap, silver, gold miners, transports, utilities. Man, when these are up at the top, I know this was not a great week to be in stocks. It was not a great week to be in growth, I think is the answer. If you look at ARKK and whether this is profit taking or not, down a couple of percent on Friday, 4.5% on the week. Bitcoin was hammered, not much volatility, and the dollar came down as well. If I look at the S&P, we've already done this enough. I'm not going to beat up. Look at the move up on the weekly, and we're really close to touching this line here, which has been resistance on the way up. If we look at the Dow Jones Industrials, I'm going to go very quick here. Oh, I hate when it does it this way. Dow looks like the S&P, just flatter. Do we have a double top in here? I love when Oscar Carboni starts doing his ranting and raving, which is, I think, hilarious. I think that's his shtick, and it's funny as heck if you've never heard him. He says sell double tops. We kind of got I hate when I do that. Sell double tops. We're kind of got a double top on the Dow. Let's go back and look at the S&P 500. Don't have a double top because if we had a double top, it was closer to here. And we broke out of the double top on the S&P. What about the Russell? Man, the Russell. What a year for the Russell if you like sideways. I'm going to start over on the left. The highs, the lows. And if there wasn't a Darvis box before, you had a clear box in the market. Here was the false breakout. You can buy buy support, sell resistance. Right now we're in the middle. If we look at the Nasdaq real quick. Not the tool I wanted. Let me kill that. What did I do there? Oh, drawing a white line on a white background. Really not smart, Jeff. And you got your highs over here. So Nasdaq's a little bit off its highs. So high, low road, medium road. I mean, it's pretty simple. High road is we get volume in, we go out and set new highs. Low road is we probably go down and test the 200, and that's a pretty big range. And what's the middle road? Middle road is we keep doing what we've been doing, chopping around. What I think is most likely, probably the middle road scenario. All right. Now, what else goes beneath this? Really quickly, let's look at the Ibd50 stocks. This is an area here. Whether you like trend lines or not, I guess I'm in a trend line move. This is an area I don't think that's a straight line. That is a straight line. I didn't feel like it was a straight line. This is an area where it's reversed before. It's still got a lot of overhead resistance supply. If I look at the fangs, we know that they bumped up on Monday and came back down. Really haven't broken, still above the 200, but well off their highs. What's ugly is biotech, and I think biotech's problem is Moderna, Novavax, BioNTech, all great companies that have changed the world for COVID, maybe. Yes, I'm a vax guy, I've been vaccinated. But they caused this rise, and now they've all softened. There's such a big component of some of these ETFs. They've pulled back, but it's not just them. Look at something like Amazon. Biotech is weak. How about semiconductors? This has been saving the market. Up near the highs. Didn't do much this week. You want to look at weak, you can look at ARC Innovation. Yeah, what a great sell signal failing at the 200. ARC Innovation's weak, and a lot of this is Tesla. We're going to look at Tesla in a few minutes. I think that's a key stock as to what this market's going to do. If I look at the dollar bullish ETF, as we saw, it's weakened some, pulling into the 50. It's way off its all-time high or recent high. If I look at gold, gold showed some life with the weakening dollar. Gold popped up here. Kind of looks interesting. Broke above the descending trend line. Gold looks interesting. Look at the improvement relative strength on the week. There's probably some on the daily, just harder to see. Gold miners. So is it finally time to buy gold stocks? Still lots of overhead supply, but improving. Silver has not really behaved as nicely as gold, and you can see it looks like the miners. Oil, which has been strong, pulled in a little bit, still near its highs of, frankly, the year. Remember when oil went to zero, negative? If only you bought 1,000 barrels and stuck it in a tanker for a few months. What I wanted to look at was, oh, Jeffrey, where were you going before you forget? I forgot. Oh, yeah. Let's look at natural gas. So it's funny, one of the seasonal plays this year has been natural gas. And because you can see natural gas is weak. And let me see what it looks like in Seasonality Trader. Yeah, I know it's not on the picture. So I had actually bought some KOLD. I sold it because I didn't like how it was behaving. And this is supposed to have strong seasonality this year. And it did pop here. You can see all the kahunas in a row. That's why I bought it. This is sort of my favorite time when I see mobile breakup with the squeeze and a kahuna. And this is a short of natural gas. But there's been so many crazy things going on with the Russians and the European natural gas prices going up. There's too much volatility, so it wasn't behaving, so I got out. F7 industry groups, warehouse view. I've got 174 in this product, HGSI. Force up, I've got 46. Force down, these are short term. I got 21. So short term, there's some upside. So let's look at some of the bulls. Let's make sure I rank it by combo. So the best ones are up at the top. Semiconductors have been at the top for a long time. Himax broke out this week. I missed this one. I've been playing a number of others. Now, one of the nice things about HGSI, if you go down to the third screen, not only does it tell me what earnings look like coming up, when you see zeros, assume they just don't have the data. Growth rates, 3 and 4 digits, multiple single digit. Typically, a stock's going to go up, pays a small dividend under high demand. Revenue has been growing. Earnings are not to February 3rd. It's up 40% or so in just a few days. Probably too high for me to jump in, but this one could go higher. And then you get to the index. Typically, I don't go below the index. Let's look at, these are the devices. So where's NVIDIA? So the ones here that I've been playing, just look at them very quickly, sold off a little bit this week. AMD, market leader, absolutely. It's got negativity here. It's on my buy watch list because it's a watch. It's pulling into the 50. If we got any strength this week, this is a market leader. I bet it goes high. It's under demand. Earnings are slowing, but are still good. This has been a big leader, as you can see. And the other one I'm playing, let's see, I'm playing NVDA. Very similar, pulling back into the 50. And then another one is SITM, sitting right below the chandelier stop. And then another one that I like is AOSL. This one's had a big move as well. And why do I like it? Go right here. Mobile breakout from a squeeze, breakout above the moving average, a kahuna, John Person buy signal. So many of the things that I look at. And again, if you haven't seen my dots, it incorporates all that in a single indicator. All right, which I don't sell today. Back. Precious metal mining, right click, change to index group. As I mentioned, maybe it's a good time to buy gold. Barrick, still way low in its pattern. I like to find something that's breaking out, moving up. Newmont mining, there you go. Shallow saucer below the 200, broke above the 200. Relative strength is improving. Don't like the earnings per share growth, but it doesn't seem to be that matters in the stock. It's done nothing with good earnings, pays a nice dividend. This is one of the big kahunas in the place. I might look at Newmont Mining. AEM, kind of down there in the low, and then you get to the... Now, it's interesting in precious mining. I like tech industries. I'm speaking my book. I've been an owner of this for a long time. It's had a major move post the March 20 lows. This one looks to me like it's breaking out. Mobile breakout, person buy signal. Had a couple kahunas on the move over here. I like tech. I've liked tech. Look at the earnings per share growth, pretty massive. Again, not a big multiple. It's funny, they have it here as precious metal mining. It's also got iron ore and a number of other things. And iron ore has been strong as well. Back. Home office furnishings, third group. Nothing is above the index, so I skip it. REITs, somewhat defensive. And there's a lot of them here that are interesting. American Tower, Cell Towers, 1.6% dividend, an expensive stock. Independence Reality gave a beautiful buy signal here. Mobile breakout from a squeeze, a new John Person buy, and multiple kahunas. That's one of my favorite signals that I look at. IRT, 1.9% dividend. Prologis benefits from supply channel with logistic warehouses throughout the world. Big up move. Ibd50, I believe they own some of the casinos. The storage stocks have been strong. Problem is, and I'm not spending much time on them, is they're all extended here. I don't like buying stuff that's extended. Crown Castle and other tower companies. Again, it's extended. All right, what else we got? Marine shipping. These guys will just kill you, but if I want to find a group that's attractive, here it is. I own some Zim, good earnings per share growth, 4.2% dividend, under demand. I guess the negative here is it's coming into a double, triple top area, so I expect resistance there. There's some cheaper ones. Starbulk, talked about this last week. I'm in this one. Weekly Bongo, great earnings per share growth, pays a 10% dividend. A lot of reasons to like that. But it was a $6 stock a year ago. If it falls $4, it takes 2 years of dividends to make up what you lost. And then you're just halfway there. Here's a one, Donatos Corp, DAC, pullback, squeeze, mobile breakup from a squeeze, person buy. I like this one, 2% dividend. So there's some of these that look interesting. Steel, remember I mentioned with tech, Cleveland Cliffs, we talked about that earlier, seems like 8 hours ago. Better not, now an hour in. Breaking out above the 50 here, like that. Vale, further down, Rio Tinto further down. I like Cliff among the ore producers, but I also like tech. Automobiles, again, some of the smaller EVs. I don't like the pattern, so I don't buy things that look like this. I'd rather wait till they come up, base, maybe get above the 50. I love Ford, and I think we're going to see Ford and GM really wow us with their EVs. Have you seen a Mustang yet? I have. They're beautiful. Here's GM. I mentioned Tesla. Let me tell you what I don't like about Tesla. Not Tata, Tesla. Here's what I don't like. That's what I don't like. I think Tesla is at a very critical juncture. And here is the 50 at about $920. Excuse me, the 100 day, and here's the 200 at about 800. I'm worried about Tesla. Tesla breaks, it pulls a lot of the market down with it. Makes me worried even more. Midstreams, a lot of these, Enbridge, not a great pattern. Pays a 5% dividend, it's got earnings per share growth. Magellan, again, these are down in their pattern, 8%. Enterprise, 8.2. Western, probably the best looking pattern of the bunch, breaking out here, 5.7% earning. Targa, not much earnings. New Star, 10.1. Good earnings producers. Consumer Finance, this is an old name, Credit Acceptance. I looked at the price, $6.75, and I wanted to pull my hair out. I used to own thousands of shares of this one. It was like $20. I don't know how many buys, sells, and whatever's happened, if it's even the same company. Nice uptrend, breaking out here at a high base. It's expensive stock, but great earnings per share growth. Opposite, cheap, old name. Is this getting ready to break out? MoneyGram. Do I even care? It's got some earnings per share growth. I'm getting tired. You must be getting tired of listening. Number 10 is casinos, one of the beaten down names of the year, Penn National. These guys have got sports books and things like that. They were the darlings. They went into the doghouse. Look at the earnings per share growth on Penn National Gaming. They did so many acquisitions. $50 stock, already under some demand. Is this a January bounce candidate after tax loss selling? How about Caesars? I think these could be interesting, and MGM has already broken back above the 50. Obviously, if you own casinos, which some of these do, COVID is not good. And then on communication equipment, it's just been up here a long time. Juniper, to me, it's too extended. Remember that JNPR, right? If I pull up my trade station, just as an example, and I apologize for these things going too long. My wife would like to kill me, to be honest, for doing them. This is extended. Well, you're above, you're 92%, and you've come down a couple days. So, in fact, you were at 100% on the high jump, and the red dots are MACD divergence. On HGSI, you can see it's tacking in across the top. I've asked for this in wealth charts. I don't know how long it will take to get that. Extended. My buy watch list on the week. And again, you have to take into account, I'm a top-down guy. What do I think the market's going to do? I've made it clear I'm a little bit worried about the market. Am I going to go jump into all these things long on Monday? Absolutely not. Now, it wouldn't surprise me to see us get a couple of days and a head fake. Do we get 3 or 4 days of strength in the market, the end of the Santa Claus rally, a lot of people with cash put to work, they did their tax loss selling? Maybe. That wouldn't surprise me. And then do we come down? Or do we have a big down day in the futures tonight, and then we end up the rest of the week crawling back? Neither of that surprises me. So I've got to wait and see what the market is doing. Some of these industry groups that we talk about, like semis and the REITs, the marine shipping, the steel, the autos, they've been up here for weeks. So it wouldn't surprise me if the market does well, that the leadership to come from here. So the first question is, what does the market do? If the market is good, I'm going to look at my buy watches. And my buy watch list is here. And I will add to it. And you'll find that many of the stocks are listed here that we talked about. And let's just look at by industry groups. A lot of marine shipping looked interesting. The midstreams with their dividends, some of the REITs. Here's one, I don't know what they do, Brightstone Capital. Why do I like this? Sideways move. It took out mobile breakup from a squeeze, new person buy, a kahuna, Bongo weekly switched. It pays a 4% dividend. I thought this was a beautiful pattern, flipping its chandelier. I like that. All right, so there are some REITs, some semiconductor devices, some specialty chemicals. Is Tronics the one I like so much? Breaking out here. I thought there was one I liked better. BCE, I've been looking for my AT&T replacement. A telecom carrier with a long history of dividend over 5%, 5.3%, and it's done almost nothing, maybe even trended up during the market entropy as a Canadian. But you can see we've got some utilities, exploration, one, some precious metals. There's your Newmont and your tech. COVID gets bad. This is a COVID stock. This is Brunswick. They make a lot of outdoor sports stuff, facing for a long time. Clean Harbors. It's pulled back to the 200. But if you look at this in some of my other products, person buy, mobile breakout, it looks like it's coming off of trend line support. And it's easy to see that. All I got to do here is I think that was what interested me on this, was the long-term trend line support. So these are some of the stocks I like. Again, the market will define what I do, not the list that I put together with last week's data. Now, let's say this market rolls over. Do I have a list of shorts? I do. I got a lot of shorting candidates, and there are a lot of names that you've heard before. So I thought what I would do now is let's go look at in TradeStation. 5 more minutes or less. Let's go into my screener. Let's look at my sells. Here are some of my shorts. These are monthly, weekly, and daily. I have AMG broke down below trendline support here. It's got a low close doji on the monthly, and it's got a sell signal at resistance on the daily. If this market sells off, this is one I look to short. Amazon, you know, it's hard to short this because it doesn't seem to be doing anything this year, but a breakdown below this trend line. Here's the weekly. I get into here, I'd be looking at taking a short position. Amgen, again, if this market sells off, this thing could run a long way breaking down below this trend line support. Boeing can't get above this monthly descending trend line. Weekly has a sell signal at the daily, should come down at least to test back here. This has been one of my favorites of the year, Centene. Centene is reversing here. It's in an uptrend. I'm less excited about shorting this one. But again, if the market pulls back, this thing will come back down. Always does. Charter, high price stock. It's already on its way down. But you know what? It's pulled right back up into trend line support, or trend line resistance, and got a sell signal. Again, I'm not shorting all these tomorrow. I'm building a list to start looking at if this market rolls over. Failing at the trend line is Cracker Barrel. Goldman clearly looks like on the monthly it's topping. It's broken down some on the weekly, and it's got a sell signal at trend line resistance on the day. Intuitive Surgical, strong on the weekly, still strong on the daily, a new sell signal, a long way to drop. This is one that usually moves a lot if the market corrects. Lulu, monthly sell signal, breakdown here on the weekly, and a sell signal at resistance on the daily. New Residential, low close doji, and then another doji, breakdown below trend line on the weekly, and a sell signal near resistance with a low close doji on the daily. Progenesis, breakdown on the monthly, bear flag, and a failure at resistance. Salesforce, breakdown on the monthly, a little bit of a bear flag in here, and potentially a breakdown at resistance. Shopify, sideways on the monthly, going nowhere on the weekly, perhaps a bear flag into resistance on the daily. Stryker, equal and opposite, so sideways on the daily, trying to do something on the weekly, but coming up against a big resistance, at least a double top on the daily with the sell signal. And here's Tesla with auto-generated trend line, what I was drawing for you here. Failed here. Looking ugly here on the monthly. Sell signal at resistance. It's hard for me to come out and short Tesla. But what I'm showing you were a bunch of former leaders. Zoetis, why would I talk about this? Because we've got a bit of a sell signal here at a high. This is not my favorite one by far. These are all former leaders. They're all expensive stocks. And if this market rolls over, I'd rather go where the money is, and I'll probably short some of these. So I'm making my list and checking it twice. I'm going to find out which stocks are naughty and nice, although that holiday is already gone. But I think the markets matter. If this market holds up and goes higher, I think there are some interesting opportunities. Are we closer to a high or to a low? Well, of course, we're probably closer to a high. So let me bring up wealth charts, and then I want to say goodbye. These are a series of moving averages. Those who've been to my live meetings have seen me go back to the Depression and show you what every market rollover looks like. So let's just take the spider and let's go show you what I'm talking about. I got to build some time. Okay. So as we know, we've been in a very strong market. I'd like to get us back to 2007, 8, 9. All right, there we go. Go back a couple more years. Ignore the red and green dots. A strong market will track above the shortest of the moving averages. In a medium market, we will pull into the moving averages. In a weak market, we will retest and fail into the moving averages. When we're below the moving averages, you do not want to be chasing longs, trust me. Other things that happen when you turn into a downtrend, the shortest moving average, which is at the top, will flip and will be at the bottom, as will the others over time. So here's 2007, nice run up. For those who were not paying attention, there were some Hindenburgs that occurred here, and the market had a pullback. It was damaged, but we pulled back into the moving averages and we bounced. And then 2008, we had some more Hindenburgs, and we pulled, we bounced, we failed at a area, double, triple top, whatever, and we came back into the moving averages. So notice here, 2008, we're in the moving averages, we flipped, came out, went right back in, and we broke below. So I think you remember what happened here in 2008. The markets imploded. And when did they reverse? Well, they reversed in 2009. So lots of head fakes where we pulled into the moving averages and failed, into moving averages and failed. Notice from the time that we've failed a retest, we have not popped above those moving averages. This is what a bear market looks like. You get ferocious rallies in a bear market, and then what happened? So off the low, and you might not have known until you got into July that this has really changed. Maybe this was just another visit into the moving averages. You can start to see the moving averages start to flip again. And the low of the market was like March 9th, which is where the bar is. In this chart, it's hard to prove that. It's still in the midst of a bear. And then what happened? You want to be long this market, all right, and pull into the moving averages. You've had small corrections on the way up, but you want to be long when the market looks like this. When the market looks like this, you want to be taking profits. When you break down, this was a temper tantrum, I believe, in 2011. Long run up. Notice you can do this for a long period of time with just minor pullbacks. A little bit more than a minor pullback occurring in 2014. Here we got 2015. Oh yeah, I remember this one, a nasty Christmas. No Santa Claus in 2015 going into 2016. And then we set off on the new bull. Beautiful run up. 2018. What do we have here? This is the Christmas of 2018. Also a weak time. And then 2019, big run up. So what do you see? Red just means it's down weeks. Pull back there. Market's not gone yet. Boy, look at the volume. Look at the sell-off. Look at the volume. Look at the sell-off. Do you want to be long this market? No, you want to be out this market. And you can see what happened. Now we had the V-shaped recovery. And then we had this huge run up. Hard not to make money to the long. Growth stocks were doing great. Continue. Here we are. Bullish or bearish? There's your spider. There's your Dow. There's your Nasdaq. Here's your Russell. I interpret the first three as being bullish. Very bullish. All right. Certainly not looking like the big pullbacks. Could it be the beginning? Absolutely. Russell's more worrisome. Said it before. Will the strength in the large caps pull up the small caps? Or is the small caps going to pull everybody down? We got back into the moving averages this week. My hope is that since we have not broken down, we're above on the first three, above the first moving average. We're still in a bullish market. We'll see. I'm in the bull camp. I think inflation is going to slow down. I think the economy will hold on. And I think the Fed won't raise as much as they say because inflation's coming down. That's my guess. It's Sunday. This has gone on too far. Please use my link in the in YouTube or in the email that you get informing you that I posted a video to sign up for the Wealth 365. And even if you can't be there most of the time, go when you can. Every night, Rob Hoffman talks about the markets. It's a great event. Have a great week again. Safe, healthy, happy New Year to all. And we'll see you on the other side.